Well, just as central banks have started to go their own way, last week markets went in their own direction with a real divergence across the performance of a number of key markets around the globe. So on Friday night, we initially saw a rally in the US. However, it did reverse itself as investors appeared to change their mind about the information they'd received and sold the market down to finish in the red. That meant that the US markets were down slightly for the week. Now, in Australia, we were down harder, down around 1.1%. But in Hong Kong, markets were up by more than 1%. And that divergence in performance is speaking to a theme that we have been mentioning since the beginning of the year. And that is the potential for the outperformance of the market in Hong Kong as valuations come into play. Now, valuation is a dirty word in share markets at the moment. A lot of shares are entirely divorced from any reasonable valuation methodology. And yet, if in Hong Kong we have, in PE terms, a fairly undervalued index, and the strong performance we saw from the Hang Seng last week could be part of an ongoing catch-up, an ongoing outperformance as the Hang Seng moves back into line with other major global markets. Last week here in Australia, action was dominated by gold miners. In trading on Friday night, gold came within a whisker of $3,600 an ounce, and that positive momentum appears to be continuing. The gains we saw in gold mining stocks last week possibly set to continue again this week. Although the trade is getting very crowded, the direction is fairly clear at the moment. The action on Friday night deserves some closer attention because it illustrates one of the conundrums for investors at the moment. Most of the market action was driven by the jobs data that was released at the market open. Now, the non-farm payrolls, a monthly read, came in at just 22,000 jobs. And in a healthy US economy, we generally look for 200,000 to 250,000 new jobs a month. So to see just 22,000 new jobs last month is definitely bad news for the US economy, but it gets worse because the previous reads were also revised downward. Now, they'd already been revised downward the previous 3 months by 250,000 jobs. They were revised downward again. And so the situation in the US when it comes to employment is dire and has been since April and the Liberation Day tariffs that were introduced. And that is likely to have an impact on the broader US economy and, of course, company bottom lines. So the first blush reaction to this very weak read on employment was a rush higher in the market. In fact, the US markets hit all-time highs again in trading on Friday night on the back of that very weak jobs read. And the thinking is very straightforward. The investors in the US saw the weak jobs number, assumed immediately there will be interest rate cuts from the Federal Reserve, and they bought shares on the back of it. Now, it does appear over the course of the session, investors had a rethink about that because even if the US rates are heading lower, a weakening economy in the magnitude of what we've seen in the jobs numbers might overcome any benefits that a lower interest rate and easier monetary policy might provide. And so markets then reversed direction, and having touched that all-time high, they sold down to finish the session in the red, reflecting those concerns about the economy. Now, last week, we mentioned a number of times that bad news was good news, that any bad economic news was spurring the market higher. On Friday night, we saw first signs that that dynamic might be coming apart, and the economic weakness so far has been a positive for US shares. If the thinking that we saw on Friday night continues, US economic weakness might become a negative. And this could be the switch in thinking that brings about a significant correction in US markets, something to be very careful about. Now, the good news from the market's point of view was the rally in bonds. US 10-year bonds fell to 4.07%, remembering they're up at 4.5% not too long ago. US 2-year bonds got to a very low as well. And we saw big drops in financial stocks. Wells Fargo, Charles Schwab, JP Morgan, all under pressure in trading on Friday night, perhaps reflecting concerns about the outlook for markets. Turning to individual stocks, we saw some very extraordinary moves, really, in a company called Open Door, the online property transaction group. Now, it is coming back from some real lows, but it bounced by 49% last week. Its share price rose, and this is on news or reports, perhaps, that a number of hedge funds are putting pressure on the founder to return and restore Open Door to its former glory. And that in itself was enough to get the share price moving. As I say, coming from a very low level, but since July, it's moved up from 80 cents to $6.80 in trading on Friday night. Nowhere near the all-time highs of $39, but an indication perhaps that Open Door might be reviving its fortunes. One to watch. Nvidia, another much favoured stock on the Moomoo trading platform, down 7.3% the past 5 trading days. And the focus on the second quarter results does appear to have, at least according to some analysts, missed the growth story. There are valuation concerns, but at PE of a trailing 12-month PE of around 48 times does not look expensive compared to a lot of other stocks. And while those valuation concerns remain, there are a number of analysts who still have a strong buy on Nvidia. So another one to watch, particularly given that 7% plus fall last week. And locally, tech shares were also under pressure. WiseTech continued to tumble, down 8% last week. Now, let's recall there were some concerns about the personal life of the founder and CEO and chair earlier this year. Then the results came out for the half, missing earning expectations. It's down 22% year to date, but a number of analysts also retaining a buy rating, shrugging off the reputational issues and looking at the strategic positioning of this logistics business. However, many of those analysts who are bullish on the stock do acknowledge near-term growth concerns. Now, tech stocks came under pressure generally here in Australia last week, and that was echoing what was going on in the US. It still remains the most highly valued sector in terms of stretched PEs, but the pressure that we've seen and the corrective action may be putting it back into a territory where local investors will be looking to buy the tech dip.